Every so often, a headline appears. Someone enormously wealthy paid a lower tax rate than their assistant. People assume it's a loophole, a clever accountant, something shady you and I can't touch. But here's the uncomfortable truth. Most of it is completely legal, written right into the rules, and built on three ideas an ordinary person on an average salary can actually copy. The tax system isn't rigged in secret. It's rigged in plain sight. It just rewards behavior most people never learn about. This isn't tax advice, and it isn't about dodging anything. It's about understanding why the wealthy pay less and which parts you can use. And before we get into it, if you want the way money actually works explained without the hype, don't forget to subscribe and give a thumbs up. Here's the foundation everything else rests on. The tax system doesn't treat all money the same. It taxes how you earn far more than most people realize. When you earn a paycheck, that's earned income, wages for your time. And in most systems, it's taxed at the highest rates, often taken out before you even see it. But money that comes from owning things, investments, businesses, assets that grow in value, is frequently taxed differently and often more gently. That's the whole secret in one sentence. The wealthy earn most of their money through ownership, not wages, and ownership tends to sit in the lower taxed lane. The average person earns almost everything through wages, in the higher taxed lane, and never realizes there's another lane at all. You may never own a giant business, but you can absolutely start moving some of your money into the ownership lane. That's what the three moves are about. Move 1. Use tax-advantaged accounts, the most powerful tool you're probably underusing. Most countries offer special accounts designed to encourage retirement and long-term saving, and inside them, your investments grow with the tax either deferred or, in some cases, removed entirely. The names differ by country, but the idea is universal. The government deliberately offers a tax break to people who invest for the long term. Here's why this is so powerful. Removing the yearly tax drag lets compounding run at full speed. Illustratively, the same money in the same investments can end up meaningfully larger inside a tax-advantaged account than in a regular one, purely because the tax wasn't nibbling at it along the way. The wealthy max these out as a baseline. Most ordinary people leave a large part of the available room unused every year, which means leaving a legal tax break on the table. This is the single most copyable move on the list. Move 2. Hold investments for the long term, and let the tax code reward your patience. In many tax systems, if you sell an investment quickly, any gain is taxed at a higher short-term rate. But if you hold it past a certain point, often around a year or more, the gain can qualify for a lower long-term rate. Same investment, same profit, lower tax bill, just for waiting. And there's a second, quieter advantage. As long as you don't sell, gains that are still growing usually aren't taxed at all yet. The wealthy use this constantly. They let assets grow for years, even decades, without triggering a tax bill, because tax is often only due when you sell. For an ordinary investor, this lines up perfectly with the boring strategy that already works. Buy broad, low-cost index funds and hold them for the long haul. You weren't going to day trade anyway, and the tax code quietly pays you for that patience. Move 3. Own assets and understand legitimate deductions. This is the most advanced lane and the most misunderstood. When you own income-producing assets, a business, rental property, investments, the rules often let you subtract legitimate costs of producing that income before the tax is calculated. An employee is generally taxed on their gross wage. An owner is frequently taxed on what's left after real expenses. Same dollar in, very different starting point for the tax. Now the honest caveat, and it's a big one. This is also where people get into trouble, by inventing fake business expenses or copying schemes off the internet. The legal version is real and powerful. Own genuine assets, keep clean records, and claim only deductions you're actually entitled to. The illegal version is just fraud with extra steps. Know the difference. And when it gets complex, that's exactly when a real tax professional pays for themselves. You don't need a corporate empire to start. Owning index funds in a tax-advantaged account already puts you on this path. The mindset shift is what matters. Stop thinking only like an earner and start thinking even a little like an owner. So here's the reframe. The wealthy don't pay less tax because of a secret phone number. They pay less because the rules, written in the open, reward owning over earning, patience over speed, and assets over wages. You can't rewrite the tax code, but you can stop playing only in the highest taxed lane when there's a legal, slower lane open right beside it. Start with Move 1 this week. Find out what tax-advantaged room you're leaving unused. It's the easiest legal tax break most people ignore. And because tax rules genuinely differ by country and change often, treat this as the map, not the turn-by-turn. For your specifics, a licensed tax professional is worth every penny. Remember, this channel is for education only. It is not financial or tax advice. If this finally made the headlines make sense, don't forget to subscribe and give a thumbs up. Every week we break down how money actually works, no hype. The free net worth tracker in the description helps you grow the assets that put you in that gentler lane. Now I want to hear from you, so tell me in the comments. Which of the 3 moves are you starting with first? Tax-advantaged accounts, holding long-term, or owning assets? I'll see you in the next one.